Warren Buffett once said, "You only find out who's been swimming naked when the tide goes out." Think about that. Every boom makes people feel like geniuses until the tide turns and their mistakes stand there, exposed. The funny thing? Most investors don't lose money because of bad luck. They lose it because of quiet mistakes, the ones you don't even notice while you're making them. Overconfidence, hype, timing, emotion. Buffett's seen all of it. And here's the kicker. You might be making one of those mistakes right now without realizing it. Stick with me, because over the next few minutes, we're going to uncover the 10 biggest investment mistakes Buffett says ruin portfolios. And number 7, even the smart investors fall for it. Here's where we're going. We're walking through 10 mistakes almost every investor makes, and the lessons Buffett learned watching people repeat them for decades. You'll see why smart people chase the wrong stocks, why timing the market never works, and how emotions quietly wreck good decisions. But don't skip ahead, because near the end, there's a mistake almost every experienced investor still makes, and it's probably not the one you think. Ready? Let's start with the first one, the one that tricks even confident investors. Overconfidence. Mistake number 1, overconfidence, the silent portfolio killer. Overconfidence might be the most expensive emotion on Wall Street because it never feels like a mistake when you're making it. You buy a stock, it rises 10%. You feel brilliant. You think, "I knew it." Then you double down. And that's when the market reminds you who's really in charge. Buffett has a quiet rule. You don't know what you don't know. The problem with overconfidence isn't arrogance, it's blindness. When you start believing you see the future, you stop checking the facts. You stop asking, what could go wrong? Buffett's different. He assumes he's probably missing something. He studies until the numbers make sense. Then he moves slowly. Here's the takeaway. If your confidence ever starts to feel like certainty, pause. Because certainty in investing is usually the start of a very expensive lesson, which brings us to mistake number 2, chasing the crowd. Mistake number 2, chasing hot trends, the fear of missing out. You've seen this movie before. A new technology hits the headlines, crypto, AI, EVs, and everyone's suddenly an expert. You tell yourself, I'll just ride the wave for a bit. Buffett calls this the investor's disease. You stop being an investor and start being a chaser. Because when a trend's hot, price is already baked in everyone's excitement. You're paying extra for emotion, not for value. Buffett's rule here is simple. Be fearful when others are greedy and greedy when others are fearful. But it's not about being contrarian for the sake of it. It's about timing your thinking, not the market. Remember, the crowd always looks right before it's wrong. And speaking of timing, mistake number 3 is one nearly every investor swears they don't make until they do. Mistake number 3, trying to time the market, the illusion of control. If you've ever said, I'll sell now and buy back when it drops, congratulations. You've just tried to time the market. It feels smart, right? Logical. But here's what Buffett knows. Nobody can predict the next move, not even him. The market rises on bad news and crashes on good news. Logic doesn't always show up on Wall Street's calendar. Buffett's secret weapon isn't prediction, it's patience. He buys good companies, then lets time do the heavy lifting. He once said, "Time is the friend of the wonderful business and the enemy of the mediocre." Trying to time the market means trying to outsmart everyone, and usually you just outsmart yourself. The truth? Time in the market beats timing the market. Always. Now, timing isn't the only thing people ignore. The next mistake is sneakier, and Buffett can't stand it. Mistake number 4, ignoring fundamentals, buying stories, not businesses. It's easy to get caught up in stories. The next Tesla, the next Amazon, the next whatever. The problem, stories don't pay dividends. Profits do. Buffett's edge is simple. He doesn't buy stocks. He buys businesses. He reads balance sheets, cash flow statements, and company reports. Not headlines, not hype. Most investors skip that part. They buy because a chart looks good, or someone on YouTube said it's undervalued. But Buffett knows, numbers tell the truth long before the price does. When you ignore fundamentals, you're betting on noise. When you study them, you're investing in truth. So before you buy anything, ask yourself, if this stock didn't trade for 5 years, would I still want to own the business? Most people won't do that homework, and that's why emotions take over next. Mistake number 5, letting emotions drive decisions. The fear and greed cycle. Fear when prices fall, greed when they rise. Those two emotions control more portfolios than logic ever will. Buffett's advice is simple but brutal. Be fearful when others are greedy, and greedy when others are fearful. But here's what he really means. Don't let your mood swing with the market. The moment your pulse decides your position, you've stopped investing and started reacting. Buffett never panics. He buys when it feels uncomfortable and waits when others rush in. Because investing isn't about how brave you feel. It's about how patient you can stay. And sometimes, patience means knowing when to stop collecting, because too much of everything is its own mistake. Mistake number 6. Overdiversification, owning too much of nothing. You've probably heard don't put all your eggs in one basket. Buffett adds a twist, but watch that basket closely. Overdiversification sounds safe, but it often hides confusion. When you own 50 companies you barely understand, you're not diversified, you're scattered. Buffett prefers focus, a few great businesses he truly understands. Because too much diversity can water down your best ideas. So here's the real question. Are you diversified or just distracted? And speaking of distraction, the next mistake happens when you stop thinking for yourself. Mistake number 7, copying others blindly, the dangerous shortcut. It's tempting to follow the experts, friends, influencers, even fund managers. You think, if they're doing it, it must be right. Buffett never does that. He studies, waits, and moves only when he understands. Blindly copying others means you inherit their risk, not their reasoning. And when things go wrong, and they will, you won't know why you bought in the first place. So before following anyone's move, ask, would I still do this if no one else was? That's independence, and that's what keeps Buffett's mistakes small. But what happens when investors forget about protecting themselves at all? That's next. Mistake number 8, ignoring the downside, no margin of safety. Most people fall in love with potential profits and forget about potential pain. They ask, how high can it go? But never, how bad could it get? Buffett's core philosophy, always have a margin of safety. It means buying at a price where even if you're a little wrong, you still come out okay. It's not pessimism, it's survival instinct, because the market doesn't care how confident you feel. Without a margin of safety, every dip becomes a disaster. With one, it's just another buying opportunity. Still, even with safety nets, some investors make this next mistake, and it's pure psychology. Mistake number 9, holding losers too long, cutting winners too early. Losses hurt, gains feel fragile. That's why so many investors hold on to losing stocks, hoping they'll bounce back, and sell winning ones too soon, before they disappear. Buffett's rule: admit fast when you're wrong. A small loss now beats a big loss later. And when you're right, let it ride. Great businesses grow for years. Don't interrupt compounding just to feel safe. Ego holds losers. Fear sells winners. Buffett does neither, but maybe the biggest mistake isn't any single trade. It's something deeper, how short our memories are. Mistake number 10, losing the long view. Forgetting time is the real edge. We live in a world obsessed with quick wins, 24-hour trades, instant updates, overnight success. But Buffett's world moves slow. He once said, "Our favorite holding period is forever." Every short-term decision steals from your long-term growth. The best investors think in decades, not days, because wealth doesn't grow in the excitement. It grows in the quiet years where nothing happens, but compounding does its work. So what ties all of this together? Every mistake we've talked about, confidence, chasing, timing, emotion, comes from one misunderstanding. People think buying a stock is like placing a bet. Buffett doesn't. He buys as if he's purchasing the entire business. He studies it, believes in it, and holds it through storms. When you start investing like an owner, everything changes. You stop caring about the ticker, and start caring about the company. You stop reacting and start reasoning. That's the Buffett mindset. And it's the difference between chasing luck and building wealth. So, which of these mistakes have you made or caught yourself about to make? Drop it in the comments. We've all been there. If you found this useful, hit like, subscribe, and don't miss the next one, Warren Buffett's 5 rules for picking a winning stock. Until then, invest with patience, not prediction.